Raising a round of venture capital isn't just a single milestone in a startup's journey. It's the beginning of a much longer and more complex process, one that requires founders to continuously prove, grow, and evolve their companies. A seed or Series A round may provide the crucial momentum needed to get a business off the ground, but it's rarely enough to get a company to profitability or scale. That's why securing the next round of funding is not just important, it's essential for long-term success. In venture capital, the real work begins after the first check is written. VCs don't just invest in companies, they partner with founders through each stage of growth, helping them prepare for what's next. That preparation starts long before another investor comes into the picture. It's about helping startups mature, meet the right benchmarks, and develop a credible and compelling story that will resonate with the next group of funders. Supporting this evolution is one of the most critical roles VCs play. When a company is approaching its next raise, whether it's Series A, B, or even growth funding, VCs focus on three core areas: traction and scalability, narrative strength, and operational readiness. Each of these becomes more important as a company moves through funding stages, and each demands close collaboration between the VC and the founder. Let's start with metrics. From the perspective of a venture capital investor, metrics aren't just numbers, they're signals. They reflect execution and they forecast scalability. At the early stages, such as between seed and Series A, VCs are looking for signs of product market fit. Are customers engaging meaningfully? Are acquisition costs trending in the right direction? Are retention rates strong? Founders may still be figuring things out, but there should be enough signal in the noise to justify further investment. At this stage, VCs often step in to help startups define what to measure and how to measure it. They help build dashboards, advise on the first data hires, and ensure the company is laying the groundwork for formal, reliable reporting. As the company progresses towards Series B, the expectations evolve. Now, VCs are looking for repeatable revenue, operational discipline, and clear unit economics. Growth should be meaningful, often 3 to 5 times year over year, and systems should be in place to track and explain how that growth is happening. By the time a startup is approaching later stage funding, metrics need to be bulletproof. There must be a credible path to profitability and validated expansion potential, whether that's international growth, vertical expansion, or deeper market penetration. At this point, VCs work closely with CFOs and leadership teams to model growth scenarios, align on hiring plans, and challenge assumptions that may not hold up under investor scrutiny. What matters most across all stages is consistency, clarity, and the ability to tie numbers back to strategic decisions. But numbers alone won't close a funding round. Investors need a story. A strong fundraising narrative doesn't just describe the company, it creates urgency, instills confidence, and paints a picture of a future that feels both ambitious and achievable. It starts with a clear problem in the market and a product that solves it in a meaningful, differentiated way. It moves through traction and evidence of demand, and then projects a future where the startup becomes a category leader. This is where experienced VCs add unique value. They help founders pressure test their stories. They challenge the assumptions behind their market sizing. They help them refine their pitch decks, identify potential objections, and prepare to answer tough questions from skeptical investors. A compelling story must align with market trends, clearly communicate the company's growth strategy, and highlight a defensible competitive edge. VCs work with founders to sharpen every element of that message, and, when needed, they bring in trusted design and storytelling experts to help refine the delivery. The moment serious investor interest begins, due diligence kicks in. For founders, this phase can be overwhelming, detailed, and time-consuming, but for seasoned venture capitalists, this is where preparation really pays off. A well-prepared company not only inspires confidence, but also accelerates the investment process and reduces friction at a time when momentum is key. VCs know exactly what new investors will ask. That's why they guide their portfolio companies to build the right systems early and long before they hit the market for another round. Due diligence isn't just about gathering documents, it's about being able to tell a consistent, credible, and well-supported story across every aspect of the business. A clean, organized data room is the first step. This includes up-to-date financials, a transparent cap table, detailed customer metrics, intellectual property assignments, and a clear governance structure. These are not optional, they're expected. Later-stage investors conduct rigorous due diligence, and any signs of disorganization or inconsistency can raise red flags and stall the process. VCs work closely with founders to ensure that all of this material is not just available, but presented in a compelling and professional way. That means consistent financial definitions, standardized reporting, and clear logic behind revenue projections or operating plans. Supporting documentation must be audit-ready, with no missing links or gaps in logic. Beyond the documentation, VCs help simulate the diligence process itself. They role-play as skeptical investors, probing the company's numbers, assumptions, and narratives. They test how the story holds up when challenged. They identify weak spots, messy financials, unclear equity ownership, customer churn that hasn't been addressed, or legal records that aren't fully executed, and they work with founders to resolve these issues before they ever reach an external investor. Startups also need to present detailed financial projections, customer data, and revenue reports that demonstrate a realistic path forward. Investors will scrutinize growth assumptions, evaluate burn rate, and validate go-to-market strategy. They'll also examine the product roadmap, hiring plans, and operational scalability. The due diligence process is where a startup has to prove that it's not just exciting, but investable. Strong VCs don't leave this up to chance. They help prepare every detail so that when the spotlight shines, the company is ready, not just to survive the scrutiny, but to pass it with flying colors. Fundraising is also about timing, and timing in venture capital can be everything. VCs advise startups to begin planning their next round when they still have at least 12 months of runway. That gives enough time to set goals, hit critical milestones, and avoid a rushed or reactive process. Raising too early can weaken the story. Raising too late can reduce leverage. VCs help founders think strategically about when to raise, who to raise from, and how much to raise. They also provide a broader market perspective, sharing insight into current investor sentiment, shifts in valuation trends, and lessons learned from other portfolio companies. All of this helps founders make better decisions and stay ahead of the curve. Finally, it's important to remember that fundraising is not a one-off event. It's a discipline. It's a rhythm that startups must integrate into their broader strategy for building a durable, scalable, and investable company. The most successful founders treat fundraising as an ongoing process. They track key metrics continuously. They maintain clean documentation. They regularly engage with potential future investors. And these every round not just to raise capital, but to level up their business. And this is exactly where the best VCs differentiate themselves. They don't just write checks and wait. They challenge their founders to raise the bar. They help them craft the right strategy, prepare the right materials, and connect with the right people. They support them through every investor meeting and every negotiation. They make sure the company is not just fundable, but positioned for long-term success. Because at the end, the journey from one funding round to the next is a defining part of any startup story. With the right preparation and the right partners, that journey becomes not just a scramble for survival, but a springboard for exponential growth.